I think you're kind of the same mind as what we just heard from Steve. The first quarter in general might be weak. Maybe, I don't know what happens with the jobs number today, but then the second and third quarter, we're going to resume growth. Jobs will continue to be strong, and the Fed shouldn't forget that maybe there is and Darrell, I think, thinks there's another rate hike in the cards as well. But
yeah, so we've got just one. And
one more, but the Fed should stay vigilant and not assume that there's a global slowdown.
Absolutely. They need to pay attention, I think, in both directions. We wrote back in December that it became clear they were going to hike in December, but that probably they shouldn't, and they sort of caught up with that several weeks later. But yeah, no, we think the first quarter is going to be soft. We think the jobs number is going to come. We're not too far away from consensus. We're at 175. We've been saying literally since last summer that we were going to get a slowdown in Q4 of last year and Q1 of this year because of the trade war with China, and that's going to cause a temporary drop in activity. But once we get through the first quarter, we should step back up to something like 2.5% for Q2 and Q3.
And UBS thinks a trade deal is imminent.
All the indications are in that direction. It looks like the administration is willing to basically take what they can get to avoid sort of the pain and the uncertainty that's coming from the back and forth with the trade war.
So we like to worry, and there are worry warts all the time. We just had Tom Gimbel from LaSalle saying he didn't really understand it. So in your view, things are still pretty solid. The economic backdrop in this country is pretty solid.
So yeah, it looks like the bones of the economy are pretty good. Now, there's always risks to an economy, and I get uncomfortable if I don't have something to worry about. But yeah, it seems like once companies learn how to navigate these tariffs, once people get more confidence if the trade deal is reached, we should be able to step back up.
Darrell Cronk, have you met Diane Swank?
I have. We've been on together before.
I don't see why we don't do that every time. Could just introduce Darrell Cronk.
You got to make it happen,
Swank.
Joe.
Huh?
You got to make it happen.
Because you're both, I mean, we have you separately. Why not? I guess it's confusing, though. So you heard,
yeah.
You have similar feelings?
Yeah, we think the Fed is one more time, second half of the year. As for today, we're going to buck the trend a little bit and say lower jobs print this morning for a couple reasons. One is you pulled through decent job growth in December and January. Two, the survey week in February when we took the survey, big snow, a lot of weather, right, which tends to impact the numbers. And three, if you go back and look at the math, whenever you get really slow retail sales and weak PMIs and some of the weak industrial production and durable goods, all the batch of weak economic data, what tends to happen is jobs lag by about 30 to 60 days and you see a slowdown. And I think that probably shows up a little bit here in the February data.
One more maximum, though. Can I ask both of you just something that I hear bandied about by the people that are really negative, and that is that we're having a lot of trouble normalizing because we averted disaster 10 years ago, but we did it in a way that was going to have long-term consequences. We built it on the foundations on balsa wood, and at this point, we've issued so much free liquidity that at some point, as we try to raise rates, we just can't do it anymore. And there is a big day of reckoning coming. Is there any truth to that?
So there might be, but I'm scared.
What do you mean there might be? If there is,
I mean, so obviously when there's more debt, people become a little bit more sensitive to interest rates. But I think the general cyclical behavior is roughly intact. I think the problem here is we're in this longer run trajectory of lower inflation, more disinflation.
So that's all it is, and it's not that we're unable to raise rates because we've inflated things too much. That's not what it is. The bubble, there's not a huge bubble that's going to.
Yeah, no, that's not my take on it. I would have said instead what happened was the Fed, because they were sort of very much taken by the patterns in the past, started raising rates in 2015 and 2016 on the forecast that inflation was going to rise, and they were just premature, so they shouldn't have.
What's the new? Do you adhere to the new monetary policy? What's it called? It's the AOC policy. What is it?
Monetary.
Yeah. Are you guys modern? I want to be modern. I want to be. I want to. Like.
I'm all in. I'm all in.
You don't believe that for a second.
Not for a second. But
Larry Summers doesn't believe it.
You know what's funny about it is it's really true.
There is one.
It's 100% true.
You hear it.
The government can print as much money as it wants to pay its bills until it can't.
Right. But nobody knows when that time runs out.
You guys know the term debase, when you debase something?
Yes.
You know where that comes from? It comes from the 1,000 millennial history of emperors and dictators putting base metal into precious
into
metal.
gold, yeah,
And
into
so
the-
that you debase the currency.
Right.
So we can pay bills, we can write checks, in fact, we don't even have to write. We could just
it'd be
click,
good.
click keys.
Be good.
And we've been sending people money.
Because we need 94 trillion to
Stack,
make
hold on a
everything.
second. I'm going to send some. Joey, how much do you want?
94
I'm gonna
trillion.
Send some. Okay.
Because we want to make everything free, but we need 94 trillion. If we can print it, why not do it? It's not a cost. It's an investment.
Well, I think to be
right,
fair,
Andrew?
to be fair
to solve the injustice, dude, that we were just talking about. Can we do it?
So the MMT folks, though, would say the limit on these things comes when you start to see inflation, which is, I think, the same thing Steve is saying.
As
So
Steve, right.
there is a
Depreciate
way
the
you can
currency.
take their arguments and convert them into fairly standard macro thinking about these sorts of things. Their point that you keep issuing government spending, and that's going to increase the money supply. That's based on the assumption that the Fed's just going to go out and be
We might
buying.
be able to do
assets.
more deficit-wise. We might. I mean, look at everybody who's predicted
We'll see.
the end of the world based on the deficit has been wrong.
The inflation rate was
What's
over
that?
$1 million
the
in
might.
Venezuela. Right?
Right.
The
Might work,
inflation
it might not. Let's see.
If trade deficits and budget deficits are where they are, you would think the dollar would be weak,
Right.
right?
Well,
So you'll
unless
see
you
it.
compare us to everybody
Except
else,
you're
like
the
the
worst,
ECB.
That's true, but if this new monetary policy is true, you're going to see it show up in rates and the
It's a
fiat currency
comparative. It's a
eventually.
comparative strategy.